Section 6, the Secondary Mortgage Market. Unit 1, Secondary Mortgage Market Process and Products. Unit 2, Secondary Mortgage Market Concepts. Unit 3, Secondary Mortgage Market Players. Unit 1, Secondary Mortgage Market Process and Products. Lesson 1, the Secondary Mortgage Market Process. Lesson 2, Mortgage-Backed Securities. Lesson 3, Collateralized Mortgage Obligations and Real Estate Mortgage Investment Conduits. Lesson 4, CMOs and the 2007 Financial Crisis. CMOs and the 2007 Financial Crisis. Prior to the 2007 subprime mortgage crisis, housing prices were rising rapidly and investors couldn't lose. Rampant speculation swept the market. However, not everyone wanted to manage rentals or other investment properties. Where there's a market, a service or product will arise to meet it. Soon, private companies began offering CMOs. Many CMOs included adjustable-rate mortgages, subprime loans, and other high-risk loans. However, in the can't-lose environment that was the early 2000s, investors were more interested in potential returns than in the quality or health of the underlying mortgages. Many investors flocked to CMOs issued by private companies who had less stringent underwriting standards than those required by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac saw their market share declining, so they also started purchasing these CMOs, which included subprime loans. All of this would have been fine if housing prices could have continued their upward trajectory. But that didn't happen. Home prices began to fall. Borrowers couldn't refinance because their loan balances now exceeded the value of the collateral, their homes. Borrowers began missing mortgage payments and foreclosure rates increased. CMOs weren't collecting the expected principal and interest payments due to the increase in foreclosures for their underlying collateral. Subprime lenders started going out of business, and even Fannie Mae and Freddie Mac suffered and were eventually placed under the conservatorship of the Federal Housing Finance Agency, which focused on stabilizing operations and preventing more foreclosures. Real Estate Mortgage Investment Conduit, REMIC. A REMIC is a collateralized mortgage obligation, CMO, disguised as an entity or company. Some REMICs were created as a result of the Tax Reform Act of 1986. Given certain requirements are met, an election can be made with the IRS to create a REMIC. Most CMOs are REMICs because of the tax benefits a REMIC offers, mainly avoiding double taxation of income. As a result, from a federal income tax perspective, the REMIC is treated as a partnership. Income received by the REMIC is not taxed at the company level. Instead, after the income is passed through to investors, it becomes taxable. Here's the difference in taxation between a REMIC and CMO. Mortgage-backed securities, MBSs. Banks sell issued mortgages on the secondary market. Secondary market institution groups these mortgages into a mortgage-backed security and sells shares of this security to investors. Money received from investors is used by secondary market institutions to purchase additional loans. Principal and interest payments filter through from borrower to bank to MBS to investors, minus fees along the way. Mortgage-backed securities, MBSs, and interest rates. When interest rates rise, borrowing money becomes more expensive for consumers as they'll have to pay more interest on their loans. Investors benefit from these higher interest payments, which eventually pass through to them. When interest rates fall, borrowing money becomes cheaper for consumers. They won't pay as much on interest. Investors suffer from these lower interest payments. This means less money passes through to them. The secondary mortgage market process video transcript. A consumer wants to purchase a home and applies for a loan through a local bank. Local banks want to grant lots of loans but have a limited amount of money. So they sell their loans on the secondary mortgage market to an institution like Fannie Mae. This allows local banks to keep giving out loans, making it easier and cheaper for consumers to borrow. Fannie Mae, who now owns a bunch of loans from different small banks, packages them into a mortgage-backed security or MBS and sells the security to an investment bank like JP Morgan. Investors can then buy shares in the MBS. When the consumer pays a monthly premium, everyone gets a cut. The local bank that made the loan, Fannie Mae, and JP Morgan all take a small percentage, and the remainder is paid out to whomever invested in the security.